What is the euro crisis? It is, in simple words, the failure of euro, a currency which ties together 17 European countries. A currency, which in over the past 3 years, has brought Greece, Ireland, Italy, Portugal, Spain, and Cyprus, to the brink of bankruptcy, giving birth to the European sovereign debt crisis, and threatening the European Union into an existential crisis. But how did it all started? What events brought the ever so prosperous European Union on the verge of total economic collapse? Let's find out. The European Union was initially set up as an economic community, consisting of Belgium, France, Italy, Luxembourg, the Netherlands, and West Germany. The main motive of this union was to unify the war-torn Europe through economic cooperation, in the aftermath of World War II. Later, the European Union grew into a political and economic union of 28 member countries of the European region. This created an internal single market through a standardized system of laws that applied in all member states. This ensured the free movement of people, goods, services, and capital within the internal market. But there was one small problem. Trade between 28 countries meant trading in 28 different currencies. This was a major roadblock in the way of unprecedented economic growth of the Union. This problem was finally solved with the introduction of the euro by 2002. 19 out of 28 countries adopted the euro as their sole legal tender. The countries which adopted the euro became part of the Eurozone. And thus the European Central Bank, or the ECB, came into existence. The major role of the ECB was to set the monetary policy for the Eurozone. However, no member country agreed upon a common fiscal policy, as it compromised their sovereignty. A monetary policy is the process by which the central bank of a country or union controls either the cost of very short-term borrowing, or the monetary base, often targeting an inflation rate or interest rate, to ensure price stability and general trust in the currency. On the other hand, a fiscal policy is the means by which a government adjusts its spending levels and tax rates to monitor and influence a nation's economy. And thus, having control over the monetary policy but not a fiscal policy is like having control over the interest rates of mortgages, but not spendings. In practical terms, applying the same interest rates on borrowed money for all Eurozone countries, no matter how strong or weak a country's economy is, or how much of financially responsible a country is a recipe for disaster, not growth. As this means that, if one country gets into trouble and is unable to pay its debt, other financially stable countries will have to step in and pay the amount, as they are all bounded by the same currency. This is exactly what led to the euro crisis, and thus the sovereign debt crisis of Europe today. Politicians of Greece, Portugal, and Italy went on a government spending spree to finance public welfare projects for political gains. Whereas Ireland and Spain got lost in the limelight of the US housing market bubble by creating one in their own country, and all of which was in debt. Everything went well when credit was available, which was until 2008. But when the US housing market bubble burst, and so did the one in Spain and Ireland, suddenly no credit was available for countries like Greece, Portugal, and Italy to pay off their debt. And now, financially stable countries were bound to step in and save the situation. These countries, especially Germany, were very reluctant to bail out the troubled countries, as it believed that these countries must suffer the consequences of their own foolishness. But the euro forced Germany to bail out these countries, and put strict austerity measures on the troubled countries, which they are refusing to accept. If this continues, and no immediate measures are taken to stop Greece going bankrupt, then it can have a domino effect on all other European countries, which will not only send entire Europe, but most probably the whole world into deep recession. All this, while the whole of Europe is already going through a migrant crisis, has forced countries like Britain, France, Sweden, the Netherlands, and Belgium, to look into the possibility of leaving the European Union. while troubled countries like Greece, Ireland, Italy, Portugal, Spain, and Cyprus are the most eager to leave the European Union as soon as possible, and adopt their own currency, which they can artificially devalue, to get an immediate economic advantage over the dollar and the euro, thus saving them from bankruptcy. Now, the only way out is either to demolish the European Union and let countries decide its own fate, or strengthen the European Union further, by introducing a strict fiscal policy for all European Union member countries, eventually giving birth to a United States of Europe. What do you think will happen? Will the European Union survive or collapse? Share your thoughts in the comment section below. I hope you enjoyed watching this video. Do check out our other videos as well. Links to a few are on your screen. Please subscribe and do not forget to hit the like button. See you in another video. Thanks for watching.